So the Modern Family Dynasty newsletter comes out every Friday, and this is kind of a recap, a little bit deeper dive in some of the strategies that we talk about. This will be posted in the Wealth for Life group, and we'll also go to YouTube, and it will also go to the podcast as well, so you can check it out on your different formats. But today's topic is kind of about taxes versus market losses, which is worse. And one of the things that I have in there in this week's newsletter is when you look at the actual number and you see this thing like $250,000 in tax payments equals $1 million in lost wealth minimum. And you want to go, man, how do we get there? Maybe that 250K is 1 year of extra tax payments or 5 years. But the way that you get to that, and a lot of this information came from Scott Galloway. If you follow Scott Galloway, NYU professor, very smart, he had a talk about how people that are making this 150,000 a year to 1 million a year, they're kind of the workhorses of the economy. They're getting pounded with taxes. And in his personal situation, he's had a number of exits from, big companies, somewhere in the 25 million range, I want to say overall. But his effective tax has been somewhere in the 18% range, where there's so many people making 150 to 1 million that they're actually paying, upwards in that 30-40% range. And so it's like, how do we get to those numbers? There's a great calculator you can access on talent.com. They have a tax calculator right up there. You can put in your salary, and it's going to give you this basic number of what taxes are. Because the misleading thing is it's not just federal taxes. There are other taxes coming out, like state taxes, Social Security, Medicare, and it's going to depend on which state that you're in. So you can actually put in your income, and this is before deductions and everything else, but it just gives you a framework of how much you're actually paying. And to Scott's point, that when you're trying to get from this level of wealth from 150 up, into a million, the tax code starts hitting you really hard, because it's not just the federal taxes, it's all of those adding up. And so you can see here on 150,000 in income, taxes paid about 54,000 between what your employer is also paying taxes, net effective tax rate 33.7%. And of course, some states like California, New York can be higher. And as you start going up the chain and you kind of look at, here's an income in the $400,000 range, you can see taxes, went up to now you're paying, 144,000 in taxes, 36% is going there. Your net pay is 255. So the taxes start hitting you harder and harder. And as you're trying to save more, and the number gets bigger, because what you think is when you get into these higher income areas, like, man, we're going to have extra money to invest or do lots of different things. It doesn't really happen, because those net effective taxes are getting higher and higher. So here you have kind of what Scott's talking about. He's a super millionaire over here paying 18%, but yet so many people in this section of the economy, are getting hammered. Look at that real tax rate, 38.6. Now let's take income up to a million. So $1 million in income, $400,000 roughly paid in taxes. Net pay $595,000, which is a 40% effective tax. And then you start adding in, what your employer's paying on top of this. So now you get this tax rate that's somewhere in the percent range. So, that's where, when you're trying to save and you're trying to scale wealth, these numbers, kind of catch people by surprise, especially when you have a big jump in income in certain years. And so it's different than when you're looking at advice for, the rest of the country. But the kind of takeaway here is that, this is something we talked about in the LinkedIn Live event recently, taxable versus tax-free. If you take $1 and you double it 20 times in tax-free environment, it's going to turn into $1 million. If you tax it at just 25%, it only turns into $72,000. So the idea here is not to think just in terms of your investment, but how that's actually affecting your income. And if you're losing these big chunks of money every year due to, tax code, and not taking full advantage of the tax code, that's going to what's make this big difference. And that's what we talk about in the newsletter. Like, if you kept this money, let's say it's $250,000, in taxes, maybe that's 1 year. Like I said, maybe it's 50 grand a year for 5 years. Could you double it 2 times? Could you invest that 250,000 in a business? Could you invest in real estate? And over time, could that grow to 500K, and that 500K then grows to $1 million? Most people say, yeah, over the course of my life, I could probably double that minimally, minimum at 2 times. And that's how 250,000 in extra tax payments can turn into $1 million, in lost wealth. So it really adds up. And that's why, we want to look at, in the newsletter, we talk about what are the strategies that you can really use to reduce taxes. And of course, businesses and real estate are the big ones. Now, you probably already know that, okay, if you own a business, you get a good tax advantage. In real estate, everyone always talks about it, gives you good tax advantages. A lot of people don't do it, though. And so my hope is in showing these numbers over and over again, and people start to really realize, like, it's not something that you want to just forget about and not work on. Because in the reality, when you're looking at the numbers we saw, 35%, 40%, if you had an investment that was losing 35 to 40% a year, how hard would you work to get that fixed, right? You would work very hard to get it fixed, but most people just seem to think like, well, these are my taxes, or they even go to accountants. And I've had clients tell me this so many times. They went to their CPA, and the CPA was like, well, you made a lot of money, so good problem to have. Well, that's easy to say when you're not the person writing the checks. So some of the other lesser known ideas, you can read about, and I'm not saying in this situation that, hey, the idea is, not to pay taxes. Let me get this slide changed a little bit. And if I can get that over. So it's not to say, of course, that taxes aren't going to be the most important thing, or that we don't need to pay our fair share in taxes. So, but I think the real issue there is that when you are in this kind of high tax environment, and I'm not sure if that slide is showing, there we go. If you're in this high tax environment where you're always getting pounded with taxes, it creates this animosity, this mistrust, and this us versus them mentality. And the amount of good that you're able to do in the world it's the same, where if you go into this tax protected environment, you're able to retain your own wealth, grow your capital. That leads to more generosity, ingenuity, cooperation. You can actually do more good in the world. And that's where I always talk about, like, you need to just take advantage of the tax code. It's not about tax avoidance, but you want to make it so that you can actually do more good in the world, overall. On this particular article, you can read about one of the strategies I talk about in the newsletter is being your own charity, using private foundations to reduce your taxes by up to 30%. It's one of the greatest strategies out there. In fact, I have a neighbor, we're going to actually have a workshop coming up on this, but she started her own foundation. She's got a great business, heavy equipment business on the History Channel. Business is doing well. She's created her own private foundation. She likes working with horses and animal rescue. So she funds it out of her business. She gets the big tax deduction, 30% going in. Now all the money she's spending on this passion of hers is tax deductible. And she can direct that money and do good in the world in the way she wants. She's got a daughter. She helps her daughter learn and what's the process of giving value, making the community better. So that's a great strategy. We also talked about in the newsletter, in the group, you can find out about the ones I mentioned there about using loan-based split dollars. So again, taking compensation as loans, that works great for C Corps and nonprofits. Get incredible tax reduction, being able to create massive amounts of tax-free income streams using loan-based compensation. It's very well established. Then we also talk about multi-generation endowments. That's probably the best strategy on the market for incomes of over $800,000 a year. And that strategy alone, can save you hundreds of thousands of dollars. Also very well established, but it's just not, one of those strategies you're going to read about. You're not going to be able to Google it and find information. But that one is a dynamic, just a dynamite strategy to cut taxes by 50% for those. And that's what happens when people get to this like 800,000 and $1 million in income range. There's actually not a lot of, things. They kind of run out of things to do. And so that's why using these things like multi-generation endowments, man, that is one of the best ways. I've seen that save 300, 400, 500,000 a year in taxes, for clients in that range. So those are good things to look at, because when you kind of start looking at, like this particular chart here, which is, what it takes to actually get into the top 1%. This is in the newsletter too. It's about 11 million to get to the top 1%. And when you look at top 10%, you're at about 1.2 million. So again, 1.2 million to 11 million, that $10 million swing. And my belief is that a lot of that is really taxes. Taxes are a lot of what's driving that. So if you can have tax protection in there and be cutting those taxes, it frees up capital to do more and more into opportunities. It helps you to scale wealth. It has a multiplier effect. So again, I think most people on the call, probably, or on the webinar and everything else, and in our groups, know the pain of writing those big checks to taxes. So one of the takeaways also is tax protection is one, but the other one is you're not going to get there by just saving and investing. like just buying index funds. I mean, that stuff is you're going to max out at 1 to 2 million range. Only 3% of people ever get to, I think, 3 million, or maybe it's 4% get to 3 million in a 401k. So, I mean, it's like a 96% failure rate if you're trying to just kind of follow traditional conventional advice and save your way to wealth. You got to use tax protection, financial leverage, own businesses, own assets, and real estate, and things like that. So that's one of the other things we chatted about briefly in the newsletter. And lastly, I think, this image that I've kind of showed a lot of people about what really financial security really means is a lot about getting financial control. So there's 3 things to control. You control assets, you control taxes, you control income. So that's financial security. And right now, when you think about, how many things that you have that are you actually out of control with? And most people say, well, I don't really have control of my income. Maybe I only have one source of income. If I get laid off, it's going to be a problem. I don't know. I don't really have control of a lot of assets, and I don't have any control of what the government's going to do with taxes and how much, they're going to make me pay, or how much they're going to decide in the future years of my income that they want. So controlling assets, controlling taxes, controlling income, if you can work on adding pieces to this puzzle, it takes time to do. It's not like it's just easy, but it's a process. But if you get there, that's really what financial security is based in, isn't it? If you think about it, if you had control of these areas, would you feel better versus, so many things financially that conventional wisdom, I would say, tells us to set up are outside our control. So add more financial security, build control of these processes, use the newsletter, use some of the assets. And then also in the weekly newsletter, I usually have my productivity tip. And this week I was talking about my Carol bike. So if you're kind of, I have a couple kids, I run a business and it's busy and I don't have time to go to the gym for 50 minutes and do cardio. Although I do go to the gym, lift weights a couple times a week. But this Carol bike, you can do all the cardio you need in 5 minutes, 3 times a week. The science is incredible. You do a minute warm up, minute 2 warm up, 15 to 20 seconds fast, as fast as you can on the bike. 1 to 2 minute cool down, 15 to 20 seconds, you're done. And all the science they have that increases VO2 max, you get all the benefits of, running for an hour. You do that 2 or 3 times a week, you're going to have incredible cardio benefits 5 minutes at a time. So it's really easy to jump on. It's hard to make up excuses not to do that, for 5 minutes. So that's a good bike to check out. You just go to carolbike.com. So as always, all the resources that we have here, there's a QR code I just popped up there, but you can go to the Wealth for Life group on LinkedIn and you can find all these resources in there. Make sure you subscribe to the Wealth for Life Modern Family Dynasty newsletter. So thanks everyone. Enjoy the rest of your weekend and reach out anytime if you have questions.